Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial experts John and Michael Parise from Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Beech Financial Group. Well, hey there, fellas. How are you doing?
Hi, Wendy. We're doing great.
Hey, Wendy. Yeah, doing great. It's very cold out today, as we were chatting about earlier. Yes.
Like, what is going on? This is not Alaska.
And it's getting colder. They say it's going to be colder the next few days. It's crazy. But it's February still.
I'm not leaving the house. I don't know about you guys.
Atta girl.
Yeah, not the time of the year to do that.
No.
Unless you're further south.
Yes, exactly. So what do we have on tap for today?
Well, Michael and I always try to come up with a theme when we do these podcasts. That we imagine that people are thinking a certain way, clients that we talk to or people that are listening to our podcast. And we thought we'd talk about something called leverage today. And it's kind of an interesting conversation. What we mean by leverage is there's a lot of opportunity in the planning world to create things through leverage. And I know most folks understand leverage when they think about buying a real estate property, a home. They don't put 100% cash down. They leverage it by taking a mortgage out, and they kind of manage the property that way. And if you understand real estate in general, and I'm not trying to go into the weeds here, but you earn more on a leveraged property than you do cash on cash, because leverage helps you grow a percentage of improvement on the value of that property over long periods of time, and sometimes short periods of time, depending on the property itself. So we thought we'd talk about different ideas on what we mean by leverage, from not only from a real estate aspect, but from a estate aspect, purchasing other assets, leveraging people. I know it's an interesting concept, but we deal with a lot of that. And I thought it'd be a simple idea to talk about, but it has so much impact when you talk about some of the things we do from a planning standpoint. And Michael, I don't know if you want to start with anything as an example. I threw real estate out. What would be the next topic it comes to your head about leverage?
Well, I think leverage, I mean, we were planning for this episode. I think leverage, from my perspective, is really more, not so much even the numbers piece of it. I mean, there's certainly, like you were mentioning with real estate, the cash on cash versus financing and leveraging that real estate. But I think leveraging planning generationally and how you utilize your asset base to leverage that for greater family, whether it's greater family wealth, helping achieve the generational wealth goals. I think that's how I look at leverage. It sometimes maybe isn't even necessarily all about the numbers, is how I think about it. So, like one area we talk about is IRA. I call IRA planning. A lot of folks right now are sitting. I think there's, probably trillions of dollars inside of IRA accounts, mostly in your generation, that have done a phenomenal job saving, setting money aside. Obviously, as we're sitting here, we're now in a over 15-year, I think, bull market, the end of the day. So a lot of folks have a lot of wealth built up in these IRA plans that they are not going to necessarily need for their own lifestyle. And so now when you talk about, okay, well, how do we maximize the use of those assets to maybe help with other family objectives? That's how I think of leveraging.
You're not wrong.
Maybe isn't necessarily, I'm just going to take that money out for myself, because you might not need to do that. And we talk all the time with families around, I don't need my IRAs, or I don't need 50% of my IRA money because I don't want my
RMDs.
I don't want my RMDs. Exactly. So that's just one area that I think about from a leveraging perspective.
And you're right, Michael, because if you look at what's causing that conversation now, is the law changes on the Secure Act.
Mm-hmm.
It's forcing now inherited IRAs, and we've talked about this in previous podcasts. Inherited IRAs to children now have rules that you used to be able to stretch it through your lifetime to mortality. Now you have to take it out within 10 years. So to Michael's point, when you work with a lot of the clients we work with that have larger positions in IRAs, They're just tax problems. And they could lose up to 75% of the value of that IRA in taxation, whether it's income tax along with estate tax. If you do the combination, it's a lot of wealth that's lost. So that leveraging point to Michael's idea is that how do you adjust that? How do you improve that? So there's ways that we look at taking that RMD as an example, redeploying it through leveraging that dollar. And then when the client, mom and dad ultimately pass away, the value in that IRA is different because it's not in an IRA anymore. It's in a different asset class that now grows to a larger number. So it replaces the tax burden the kids had along with that RMD issue that the families are facing. So it's really a design idea. And I don't want to get into the weeds that particularly, but there are strategies that we use now with families that creates millions of dollars more wealth from that one leveraging point to the generations. Now, remember, we talk about 100-year families. So when we think about a family, it's not just mom and dad. It's how does mom and dad who don't need this asset anymore leverage that asset to have more power to the kids and grandkids or through the generations over that 100 years. I don't know if that's what we talk about.
It's using, I think, what is a lifestyle asset versus maybe a legacy asset is the term that we often use, because in that example, right, if you've established that you're comfortable with, let's just use retirement assets, if you're comfortable with those assets because or you're comfortable with your lifestyle, not needing those assets, how do we leverage that to achieve those other goals? What would your children, as an example, if they're going to inherit those assets anyway,
right? Is
there a better use of those assets today? Maybe you can take that RMD and gift it to them, as an example, or gifting it to grandchildren. Maybe that's not necessarily the best tax play. I know we talk a lot about, listen, we don't like paying more taxes than we have to.
I hate it.
But there's other variables in that equation, I think, from a planning perspective, that maybe it's not always just about maximizing tax savings. Maybe it's about, hey, I can gift those assets to my children today or my grandchildren today and really see that be put to good use. We talk a lot with gifting and families on that, where, okay, I could leave everything to my children, but in my will or my estate plan, but I'm not going to be here to really see the impact that has on them. Or maybe it's philanthropy, where I maybe leave everything into my estate plan to my favorite charity or to a family foundation. All that's wonderful and certainly should be a part of the equation, but how do I leverage that to maybe impact me today or impact the people close to me or the causes close to me today? And that's, I think, what we're talking about. So I know we can go in a lot of different directions on this concept of leverage, both quantitatively and not.
Yeah, but you brought up a good point, Michael. Leverage, when we talk about gifting, I'm a grandparent. I got 5 beautiful darlings that I care and I love to death. Grandparents, I know one thing about grandparents. They love their grandkids more than they love their kids. Clearly, that's the fact pattern. And when I talk to grandparents, they say, you're right, John. I do. So with that concept, and again, I'm not taking away from my son, but in that concept so if you want to gift to your grandkids, what's the best way to do that? So if I made a gift to a 529 plan, which is for their colleges, it supports them. That's where we see a lot of the gifting being done. Wonderful idea. It's a tax leverage piece. It works great. And my grandpa could do a lot of that. But is that the best way to use that gift? Or are there other vehicles that you can use to enhance that strategy? So I'll give you an example. If you were going to gift $25,000 a year to your grandkids, you could gift it outright to them in a 529 plan they could use for college. You could gift it to a trust that protects that asset a little bit differently and invest differently in that trust. Maybe not in the 529 plan, but other assets in a trust. Or you could use a tax leverage vehicle. And most people don't understand the life insurance world, but we look at life insurance as an asset class that has a really dynamic piece to it. There are programs out there that are not commission-based insurance. They're more tax boxes that you could put $1 in and it grows tax-free under the insurance rules. And if you structure it properly, you could take it out tax-free. Now, while I'm bringing that up, let's take that $25,000 gift. I could gift it to a trust. The trust could put it into a life insurance contract. It can insure anybody. It can insure a grandson, granddaughter. It can insure mom and dad, or even grandma and grandpa, depending on the case itself. And that's a design issue that Michael and I kind of developed with families. But let's assume it's on mom and dad. So grandma and grandpa could say, I'm going to put this $25,000 in this trust. My son is going to be the insured. So he'll go through an underwriting process for the insurance. Let's assume he's approved. That $25,000 goes into that contract, which is the variable universal life contract, which has investments to it. Now, all that growth in that policy grows tax-free. Now, why it's important? Because it's owned by the trust. Mom and dad have access to it. Grandma and grandpa could have access to it. We would design it, and grandma and grandpa wouldn't lose control over that $25,000 gift. That's important to a lot of people, by the way, because grandma and grandpa might say, what if I need that one day? What if I run into a health issue? Can I grab that? And the answer is, if you design it properly, you can. So grandma and grandpa could own the asset, but in a way where access to that access owned in that trust. The son and daughter-in-law can have access to it to support their needs if they need it. And if you design it the way we do it over that next 50, 60 years, that could be set up as a retirement plan for your grandson. And we did a case, and I'll give you the numbers. It kind of blows us away from looking at it. The family put $100,000 away in a trust. They did it for 10 years, just $100,000 a year. Again, that gifting, because grandparents want a gift. It's just how do you leverage it? Now they stopped gifting in 10 years. They don't have to. This is just one of the designs in this case. We invested that. We grew it at 7% inside this contract. By the time the grandson, he was what? I think he was 18 at the time. I think we did it, or 20.
I think 25.
Oh, thank you.
Yeah.
It's 25. By the time the grandson was 70, there was millions of dollars in this contract set for his retirement, and he could take it out tax-free. So if you think about that concept, and a lot of people say, well, how do you do all that? Well, that's leverage gifting. So it's taking the idea of gifting that's already grandma and grandpa want to do. They can gift it and control it. They could have their kids enjoy it, and then their grandkids have a focus on utilizing it over the course of the generations. So there are different ways to design it, but that's one of the leveraging points we look at from an estate planning standpoint on just a simple gifting strategy. I don't know if you want to add anything.
No, I think that's great, and I think it fits in with the leveraging concept from the perspective of really how I view that conversation with that family is it's really grandma and grandpa are almost giving an inheritance sooner than when they pass away. Correct. Because they're confident that they no longer need. So you're leveraging that asset base today to generate another benefit for your family in the future. Now you can certainly say, okay, well, I'm just going to hold on to these assets and I'm going to leave those assets to my children. And then when my children get it, they can do that strategy.
Correct.
Well, that could be 20 years into the future. Your children might be older. Your grandchildren might already be out of college and those sorts of concepts. So it is something that you have to have a little bit of a longer term view on. And again, this is not going to fit for every family, but it's that mindset shift, I think, overall into how can I use all of this success that I've generated in my lifetime, maybe to help leverage that for my family. That's how I look at it.
Yeah, and getting back to the RMD discussion, you could do the same thing with RMDs. We're working a case now where grandma and grandpa don't want the RMDs. They don't need them. They have plenty of money. We're talking to them about setting up that type of insurance contract. Now, this is a non-commission. This is a very unique contract. It's not offered typically by a lot of life agents. It's a specifically designed VUL contract just for investment purposes, if you think of it that way. But because of the rules around the tax efficiency of these contracts, it has to be tied to insurance. It's just the rules. So if you think of it that way, you can take that as RMDs, fund that contract. Insurance could be on grandma or grandpa. And then when they pass away, a death benefit gets paid to a trust or to an individual family member. If you look at the leverage of that, you eliminated all the tax exposure and it all goes out tax-free because life insurance goes out tax-free. So if you look at all the leveraging components of this, it really blows people away when we present it. I've never understood life insurance that way. Well, because it's a design issue. It's what you're trying to do as a plan. It's not because you need to buy life insurance. It's the structure and unique structure of life insurance and how it's designed to have that impact that's positive on that leveraging point. I think that's great.
I think, and you alluded to this earlier, where one of the downsides of inheriting an IRA in today's world is that is now has to be fully liquidated within 10 years. We've talked a lot about the impact of the Secure Act on generational planning for IRA assets. That strategy, if the life insurance, that specialty product is on, let's use the grandparent here, that can almost recoup the taxes that the children are going to have to pay, right? That death benefit, now it comes into the family's asset base, and now they can use that to maybe pay for the taxes that the children will have to pay on inheriting that IRA, assuming you don't want to just move the IRA right to them today, which I think, from our experience anyway, I think a lot of families, we can run a lot of numbers and projections to say you're going to be comfortable without needing to use this asset base. A lot of grandparents still want to have access to it. Yeah,
they want to hold on to it
in some way, shape, or form, which is fine. But that just has an impact generationally. And so that design that you mentioned, Dad, can really impact impact.
Yeah, and we talk a lot about asset protection for the family. Why this contract makes sense from a planning standpoint. It's owned by a trust typically, which is out of the estate of everybody, grows out of the taxable estate long-term. Again, we think 100 years. What's that asset if it's not inside this trust? What's the tax consequences by having the kids and the grandkids own that asset not in trust? So not only can grandma, grandpa have access to that trust asset, it could stay in trust until perpetuity. That's how our trust is set up, where my kids have access to the trust assets. But if, God forbid, there's a divorce in the family, or there's a drug addiction issue, all those assets are protected for the benefit of future generations. So it's really a plan that's designed for the families that we work with, but it has a lot of meaning for a lot of people that maybe not have the wealth that the people that we're dealing with, but it still works. It's just how do you take that idea and leverage it differently than you're thinking? And we all forget, well, I'm going to need all that money. How do I create a legacy to my kids? I'm going to probably spend everything I have. The answer is you can, but if you take a piece of that and gift it to this contract, as an example, you can create a legacy for the kids. Because it could be a death benefit play where when you pass away, it could be $1 million for the kids or grandkids. That's a lot of money that you could pretty much design for that benefit. So you can accomplish all this. It's just you have to do it strategically and understanding all the pieces. I don't know, Mike, any more thoughts on that estate planning, because you're the lawyer?
Well, I think it really starts with planning, I think, in terms of determining what you want to accomplish with your assets as it relates to legacy. We're talking a lot about legacy and using leverage as a way to help with that legacy. But that design, spending all of your money down. Some people want to do that. Some people say, I just want to be able to enjoy my lifestyle the way that I want to live. And I don't want to always focus on what I'm going to leave the children. I want to make sure that this asset that I've worked so hard to build is for me and my spouse, which is perfectly fine. But again, that comes at a cost. If you are somewhat concerned about legacy, maybe this strategy can help with that, because, okay, you could spend all your assets and then after your passing, you have that life insurance death benefit that then goes to the children in trust, asset protected, that now recoups and sort of replaces that value that you've lost. So it's all about doing the planning up front and the design up front.
And the option that you talked about otherwise, that if, they can still go back in and change things, means that you still always have to be nice to grandma and grandpa.
Of course.
Yes.
Well, yeah. It goes back to, and we talked a little bit on a podcast we did with some charitable folks, where we ask a question, how would you like to be remembered? And grandparents, they could do this strategic planning for their grandkids because they want to be remembered they did something for the grandkids. So it's there, it's real. The kids understand what grandma, grandpa did. It's kind of like, I'm just not going to just leave my assets to the wind. I'm going to focus because I want to be remembered by my grandkids. I did something very special for them because I'm going to build a retirement plan for them out 40 years after worry about putting an IRA away because I've built that for them from the beginning. So that's the conversation. And I say, 9 out of 10 grandparents say, well, why would I not want to do that? If I control it, my kids can use it. My grandkids are going to benefit. Well, why would I want to do that? But that's that legacy thinking. Now, to just caveat just a little bit, think it this way. Now, you have this trust that owns this asset that has this value. We refer to it as a state bank. Now that might be foreign to a lot of folks, but think about governance of assets for the next generations. You want to make sure there's a responsibility, there's an understanding of the value of those assets, what the purpose of those assets from a value-based conversation you have with your kids. There's a governance to it. So let's say, for example, you have $1 million in this trust, and your grandson said, you know what, I want to buy a house. I want to take money out. I want to take my share out of that trust and buy a house. Well, the trustee might say, well, you know what, why don't we make you a loan? Why don't we loan you the money? We'll lend you the money. You pay the trust back an interest rate. Now, in a family loan structure, there's an advantage. It's called the AFR rate. You do a lower interest rate for the family member on that structure. But it teaches the kids responsibility to pay that loan back, but they're paying themselves back. So you understand velocity of money? How do banks make money? I hope banks aren't listening to this. They make money. I give them my $100,000 deposit. They give me a 4% CD. They lend it out at 8%. That's the leverage they have. And that's a leveraging point. Well, why can't you be a bank to the family and enjoy that same leverage?
Yep.
See, a lot of people don't think at that level, but that's a design. That's an understanding that I can be a bank for my children, so they don't have to go to the local bank and give all their interest payments to a third-party bank when they could do it for the family themselves. So there's a lot of strategic thinking about leveraging these ideas. And I think that's what Michael and I spent a lot of time with, is teaching families to think differently about what they're doing with their dollars. And are they leveraging them? Are they taking advantage of the tax inefficiency of how they're investing that money to make it more tax efficient and not lose control over it? Have governance to it, create a institution for the family to utilize those assets, have a value base around it. So we could talk forever on this stuff, but that's what we get involved in. And it's almost a lot of fun when you take a client to that level, because we find that they've never had that discussion with any of their financial advisors in the past. And I'm not knocking anybody. It's just, we're specialists. We believe in that arena, and we deliver that message to our families pretty routinely on how to think differently about the net worth they have and what to do with it.
You two are pretty crafty, aren't you? Figuring this stuff out. I mean,
well, after 40 years in this business, Wendy, you learn a lot, and it's hard to teach people experience. You have to go through. That's the advantage of the old guys and old ladies, is that we have the wisdom.
Not you, Wendy, just him.
Did he call me old?
No, it is. But we have the wisdom, because we learned a lot and made all the mistakes. Didn't understand all the pieces that young people still haven't gone through yet. So it's really an education process. Say there are different ways to look at this, but they're not getting educated at that level. Remember, we're teachers first, advisors second. You don't know what you don't know. I say that 1,000,000 times a week, that we're teachers to think differently about, in this particular conversation, how to leverage the dollar you have to make it a bigger dollar and keep it protected for the benefit of that 100-year focus that you might want to have. And that's strategic. And it's, by the way, we work as part of the team with their advisors. Their advisors are in this loop because trusts have to be set up. CPAs have to understand what we're doing. They have to understand the ownership structures. This is where the complexity comes in. That's why I pay him the big bucks. That's his job, working with the family's advisors.
Not that big, but big enough.
We're like the architects, and we look at the other advisors as part of that team. So we're designing this strategy, but it has to be approved and implemented through the other advisors as well. So we're not out in the woods preaching ideas that we don't coordinate with the other advisors. That's just how we operate.
I think that along that the state bank concept, because that I think really does resonate a lot with the families that we work with. That design that you borrowing against that asset base to be able to buy a first home, let's say for a grandchild, you can have that. And this is, again, depends on the plan and what your goals are. But if that, let's use that life insurance example that you talked about. If the insured on that isn't grandma and grandpa, the insured could be the grandchild. We are working with some families right now that have that as a focus, where they want to be able to. There's a gentleman that we're working with who just had, I think, his 5th grandchild. He now wants to start this estate bank concept with his 6-month-old grandson, where he wants to start contributing funds to this, leveraging those funds to be able to create this generational estate bank for his grandson, but also that he still has benefit from. Remember, he wants to make sure he still has the benefit or the access to it, which we can design it that way. His daughter will also have the access to that, as well as his grandson. But if you sort of put the pieces together, if that insured is the grandson, who's again 6 months old, you're talking about potentially 90 to 100 years worth of, unless the laws change at some point in the future, of tax-free growth of that asset base.
It's huge. That
can benefit multiple generations of that family. It's really like creating in a way, from a tax perspective, I think like a 3-generation Roth IRA, but asset protected in a trust out of the family's estate if that's a planning goal that you have. So it's really a powerful tool. It can be a powerful tool, but it's all based on the design. It's based on what goals you have as a family, but it's a pretty powerful tool.
And Michael brought up the Roth, Wendy, and we get conversations with clients. Well, I have a Roth, my kids are never going to be taxed. It grows tax-free, which is absolutely true.
Mm-hmm.
The problem with a Roth, you can't own it in a trust. So it's exposed to the family creditors. So if you think like we think generationally, you could have a super Roth in the concept we're talking about using the insurance structure, and that could be owned in a trust, and you don't have any restrictions. You don't have any, you could put $1 million if you want away in that strategy. Can't put $1 million in a Roth. So it's really understanding the assets classes that we deal with, and Roths are most certainly a great tax strategy. It has limitations on how you control it. And that's just really understanding. And some folks, why would I want to do a Roth, and why would I want to just do this? And you could do both.
Mm-hmm.
It's just a combination of what you're trying to do with from plan. And again, we're talking about leverage gifting to the grandkids, and that's really just a very specific focus. A Roth doesn't do that. So it's really how you want to design your plan. But there's so many different ways to skin the cat. And to your point, the creativity it takes to do this, we call it connecting all the 9 dots. So you got to be able to connect all the math and show how it all works. And that's what Michael and his team does. It's a math equation. If the math works, you do it. If the math doesn't work, you don't do it. It's as simple as that. There's no emotion to it. If the math is better by doing it this way versus that way, why would you not want to consider it?
Well, I would also say the math might be better, but that might not also be the main focus, true. Right? But to your point, I think that you have to do that quantitative analysis, I think, first to determine which option might fit best. I think that leveraging an asset base from a flexibility standpoint, flexibility of access is another component as well that I think a lot of families sometimes don't focus on as much. But again, this grandparent who has that 6-month-old grandson, how he's looking at this asset base is, okay, I want to set money aside for college for my grandson. But what if he doesn't go to college? What if he doesn't need all those funds for college? Now, the law changes on 529 plans have become more flexible in recent years to allow for other access to a 529 plan beyond just simply higher education. He understands that, but he wanted to have more flexibility even than that. So he's looking at this asset base as a long-term way to leverage the contribution he's making to achieve maybe multiple objectives for his family, because he doesn't know what his grandchildren will grow up wanting to do, whether it's for a first home, maybe it's a wedding, maybe it's for college education. So that leveraging of the asset base from a flexibility of access, I think, is really important too. And that's something that not every family is going to value the same way. It's more of I think a subjective consideration, right? You can certainly say, okay, strategy A is projected to have more money than strategy B over a 15, 20-year period of time. And okay, that means we should go with that, option A. That could be fine, but option B might have way more flexibility of access, asset protection, some of those other variables that I think are a little bit more subjective. So maybe option B is better for one family versus another. So it really is, again, it's all about custom, and it's like a broken record, but it is very much a planning focus and what fits best for your family.
Yeah, and I'll shift here to business owners, because we work with a lot of business owners. This whole leveraging concept works the same way, just through a company. And I'll give you an example. When we deal with buy-sell agreements, we typically have attorneys recommend insurance to fund the buyout between the partners. that insurance can be leveraged. In other words, let's assume we had 2 senior executives and the premiums were $50,000 a year for each executive. Well, they could take money off the balance sheet of the company to pay for that, or they could borrow money from an institution that finances life insurance contracts. And now they just pay an interest rate. So we see a lot of that in the insurance world, leveraging. The math has to work. If it's better for me to leverage and borrow money to fund that objective, the math works, do it. If it doesn't work, you pay that annual premium. We see a lot of organizations love that concept. The other leveraging point is a deferred comp strategy. A lot of privately held companies that we work with always struggle with how do they maintain or retain or recruit talent to their firms. Unlike public companies that give stock options as part of a package, private companies can't do that. So these custom plans using the structure, this leveraging structure, these corporations put in place called COLI, corporate-owned life insurance, and BOLI, bank-owned life insurance. Institutions have been doing this for years, and they put money aside in these contracts. They grow tax-free, and it pays out a benefit to the executive when they retire. So these strategies have been around a long time. It's just, how do you take all these pieces and put them together from a planning standpoint and coordinate them to the family that owns that company or develops, they want to have a succession of that business to their kids and grandkids. We work with families that want to keep their business around another 100 years. Well, how do you do all that with from leveraging structure? So it gets a little bit more into the weeds with that conversation, but that's how great these ideas are when you tie all the pieces together. We always get tremendous excitement from the families we work with that they never were educated on that process, and they're taking full advantage of it. I don't know if you want to throw anything in the business side.
I mean, similar strategies in terms of what do you want to accomplish with this asset base from a business growth perspective, and how do you want to leverage that? Is this an asset that you can leave on your balance sheet for maybe a rainy day fund? Maybe let's think about how we can utilize that asset base that we're not going to spend. We're going to leave it in an account anyway. How can we use that to maybe recruit and retain some key people? That you can use these strategies to accomplish that as well. So again, it's a little bit of a mind shift for a lot of people, but how do we leverage this asset base to maybe achieve other objectives that we may have within the company?
So we put a lot of emphasis on leverage, if you could see, Wendy. We use that term a lot only because a lot of people aren't familiar with the points of leverage. And that's why I thought this podcast would be interesting to share with listeners, that we think a little differently about how we look at assets and how we leverage the benefit of those assets, whether it's real estate, company assets, trust structures, generational structures, insurance designs. These are all leveraging points to make the math work better and submit a successful plan over that next 100 years. I know I keep going that 100 years. People go, John, you always talk about 100 years. But that's what people want to create. They want to have that legacy of those assets. They want to keep in place. You know?
Yeah, so I followed most of that, but I have to tell you, I'm really happy you guys do the math. So
you have to do the math. That's why I brought it up, because when you conceptually go through this with a client, you're right. They get tied into the idea, but they also ask, well, how does it work? And what's the mechanics? And what do I have to do? And how do I have to fund it? Or how do I have to borrow? And who's going to borrow? So you're right. It gets complex, but we help them through all that. And again, through their other advisors, we typically don't do anything unless we get the attorneys, CPAs, or financial advisors that work with the family involved in this design to make sure everybody says, we understand what John and Michael are doing. We like the idea. Let's proceed. So the client feels more comfortable that everybody's on the same page.
Okay. So if anybody has more questions, guys, Michael, how do people get in touch?
You can reach us on LinkedIn, social media. We have LinkedIn, I think Facebook page as well. Both myself and my father are in Copper Beech as well. You can also reach us on our website, www.cbfgllc.com.
All right. Well, thanks so much, guys. Always a pleasure to see
thanks,
you.
Wendy.
Thank you,
And
Wendy.
thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available.
This material is for informational purposes only. Neither Osaic Wealth, Inc. nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Copper Beech is not affiliated with Osaic Wealth Incorporated. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Additional advisory services offered through Copper Beech Financial Group. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors. Any opinion expressed in this forum is not the opinions of Osaic Wealth Incorporated and have not been reviewed by the firm for completeness or accuracy. Osaic Wealth Incorporated and Copper Beech Financial Group are not affiliated with any other named business entities mentioned.